Hello all, I'm Dr.Veena, Assistant Professor in the Postgraduate and Research Department of Commerce, Ethraj College for Women, Chennai. Today's lecture is about depreciation allowance under Section 32 of Income Tax Act 1961. Depreciation being a significant aspect of the Act, an allowance is granted to taxpayers who use assets for the purpose of business or profession. Section 32 of the Act deals with the concept of depreciation and provides the rules and regulations for calculating the same. This section allows the taxpayer to claim a deduction for the wear and tear of the asset used for business purposes. Compliance with Section 32 is crucial for the businesses in order to accurately reflect the true cost of using the asset as well as for calculating the tax liability. Coming to the terms and conditions that are to be fulfilled by the assessee in order to claim depreciation allowance, there are 4 conditions. Condition number 1 talks about the ownership of the asset. 2 talks about the asset being used for the purpose of business or profession. The third condition is that the asset should have been used during the relevant previous year, and the fourth condition is with respect to the type of the assets. Now let us see the conditions in detail. Condition number 1, the asset should be owned by the assessee. The assessee can be the whole or the part owner of the asset. Co-owners can claim depreciation to the extent of the value of assets owned by each of the co-owner. On fulfilling the conditions under Section 53A of Transfer of Property Act, that is having a power of attorney, a non-registered owner can also claim depreciation allowance. The lease is also eligible, that is, right of occupancy alone matters with respect to an asset which is under lease. An asset in financial lease, so that on that asset depreciation allowance can be claimed by the assessee. Hire purchaser also has the right to claim depreciation allowance on the asset under hire purchase agreement. Condition number 2, the assets must be used in the business or profession of the taxpayer. If the asset is used for trial production, then depreciation allowance is allowed. The asset should be ready to be used by the assessee. Only the readiness matters. If the assets are not used exclusively for the purpose of business but for other purposes as well as, say for example, for the personal use of the assessee, the asset was used, then proportionate depreciation will be calculated. That is, the amount proportionate to the purpose of business can be claimed as a deduction by the assessee. The income tax officer also has the right to determine the proportionate part of the depreciation as per the Section 38 of the Act. Coming to the next condition, the period of use. The asset should be used in the relevant previous year by the assessee. If the asset was used by the assessee for a period more than 180 days in the first year of use, then the assessee can claim 100% depreciation. If the assets were used for a period less than 180 days, then only 50% depreciation can be claimed by the assessee. Coming to the next condition with respect to the type of asset, on tangible as well as intangible assets, the assessee can claim depreciation allowance. Tangible assets include building, that is the superstructure but not the site, then plant, which includes ships, vehicles, books including technical know-how, surgical equipment, etc. Intangible assets which are acquired after 31st March 1998, that is know-how, patents, copyright, trademark, franchises, etc., can be claimed as a depreciation allowance, but you cannot claim depreciation on the goodwill as well as on the cost of land. Now we will look at the way in which depreciation allowance can be computed. Depreciation is calculated on the written down value of a block of assets. Now what do you mean by block of assets? As per Section 2 subsection 11, block of assets include only those group of assets which are falling within a particular class of assets, that is, be tangible or intangible assets. If those assets are having the same percentage of depreciation, then it will fall under the same block of assets. Individual assets lose their identity under Income Tax Act as depreciation is calculated only on the block of assets rather than on the individual assets. 2 methods of computation are adopted: written down value method and straight line method. When will you adopt written down value and when will you adopt straight line method, we will discuss in due course. So this is a table with respect to the different block of assets based on the types of assets and based on the rate of depreciation. So as you can see in the table, the depreciation rate ranges from 5% to 100%. Coming to the computation, as per section 32 subsection 1 of the Income Tax Act, depreciation should be computed at a prescribed percentage on the written down value of the asset. It is calculated with respect to the actual cost of the assets. In the context of computing depreciation, it is important to understand the meaning of the term written down value and actual cost. Written down value under the Income Tax Act means where the asset is acquired in the previous year, actual cost of asset will be treated as written down value. Where the asset is acquired in an earlier year, the written down value shall be equal to the actual cost incurred less depreciation actually allowed under the Act. So coming to the various steps in order to compute the written down value of the block of assets. So this is with respect to the assessment year 24-25. The computation is as per the section 43 subsection 6 of the Act. So first step, find depreciated value of the block of assets on April 1, 2023 and actual cost of the assets falling in the block acquired during the previous year 23-24 less money received or receivable including the scrap value with respect to the block of assets which is sold, discarded, demolished or destroyed during the previous year 23-24. So balance will be the written down value of the block of assets during the previous year 24-25. So depreciation allowance can be computed as a normal depreciation or as an additional depreciation. What is normal depreciation? Like we have already seen how to calculate the written down value of the block. On that written down value, when you are calculating the depreciation based on the rate of depreciation prescribed for that block, you will get the normal depreciation. Here you have to note that if there is any expenditure which were incurred and the amount exceeds rupees 10,000, if it is in cash, it will not be allowed for depreciation allowance. That is, if it is only with the payment was made with respect to that asset and the amount exceeds rupees 10,000, if the payment is made by way of check, draft, electronic clearing system, then only it will be allowed or it will be eligible for claiming depreciation. But there are some exceptions when you are calculating the depreciation. There are basically 5 exceptions. Condition number 1 talks about the block of asset being not empty but the written down value being nil. Condition number 2 is with respect to the block of assets being empty. 3 is with respect to imported car. 4 is with respect to succession, amalgamation, etc. And 5 is with respect to the period of use of assets. So condition number 1 or the exception number 1 is when the written down value on a block of asset is nil or it is reduced to 0 or then in those cases depreciation is not admissible even though there are assets existing in the block of assets. Exception number 2, the written down value is there but the block of assets ceases to exist. That is, all the assets in the block have been transferred. So the block of assets is empty as on the last day of the previous year. Then in that case depreciation is not admissible. Condition number or exception number 3 is with respect to imported car. If the imported car were acquired by the assessee during March 1, 1975 and March 31, 2001, then those imported car depreciation allowance is not admissible unless it is used in the business of running it on hire for tourists or for the purpose of business or profession outside India. But if the imported car were acquired after March 31, 2001, then it is admissible. Exception number 4 is with respect to the assets whenever there is a change of ownership because of succession, amalgamation, business reorganization or demerger. Then in those cases calculate the amount of depreciation based on the block. Then apportion it between the predecessor and successor depending upon the number of days for which the assets were used by the respective users. And exception 5 is with respect to the period of use. In the first year of the use, if the assets were used by the assessee for a period less than 180 days, then only 50% depreciation can be claimed by the assessee. But If the assets were used for a period more than 180 days, then 100% depreciation can be claimed by the assessee. 100% depreciation can be claimed by the assessee in any of the subsequent years. Now coming to the additional depreciation. On fulfilling three conditions, the assessee is eligible to claim additional depreciation. Condition number 1 is that the assessee should be engaged in the manufacturing or production of any article or thing or generation or transmission or distribution of power. Next one, new plant and machinery acquired by the assessee and installed after March 31, 2005, the assessee can claim additional depreciation. Here, building old plant and machinery is not eligible. Third is with respect to what are the assets which are eligible under plant and machinery. All the assets can be included under plant and machinery. All the assets which are newly acquired by the assessee after 31st March 2005 can be brought under additional depreciation, provided there are some exceptions, that is ships, aircraft, used plant and machinery used in guest house, office appliances, road transport vehicles, plant and machinery where whole of actual cost is already claimed as a deduction by the assessee. In the case of all these assets, additional depreciation cannot be claimed, otherwise it can be claimed by the assessee. What is the rate of additional depreciation? If the assets were used by the assessee for a period more than 180 days in the first year, then 20%. If it is less than 180 days, then 10%. Remaining percentage can be claimed as a deduction by the assessee in the succeeding previous year. Coming to unabsorbed depreciation, if there are any or there is any unabsorbed depreciation, then it can be carried forward by the assessee in the previous year. There is no time limit with respect to number of years for which it can be carried forward. It can be carried forward in the subsequent assessment years. And when you are carried forwarding the unabsorbed depreciation, continuity of the business also does not matter. Coming to the next one, this is with respect to power units. So now we have seen that all the assets generally are claiming depreciation under the written down value method. So when will you use the straight line method? Straight line method is applicable in the case of tangible assets with which are used by the assessee for undertaking or the assessee who are engaged in the business or generation of and distribution of power. So if the assessee has opted for written down value, then when will the assessee be allowed to claim written down value on power unit? If the assessee has opted to use the written down value before the due date of furnishing return of income. And once the assessee changes the method from straight line method to written down value for the power unit, the assessee is not allowed to come back to the straight line method. Okay. So with this, I am concluding this lecture on depreciation allowance. This lecture has followed a 4-quadrant approach. Links to the study material, assessment and discussion will be provided in the description box. Thank you. Thank you once again. Thank you all.